All right, today we're going to dig into a really fascinating company in the financial tech world, Jack Henry & Associates. We're going to break down what makes their business tick, what their competitive edge is, and, the big question, does it make for a compelling investment today? In the world of tech and investing, we're always told to chase the next big thing, right? The explosive growth, the flashy disruption. But what if the strongest investment isn't about disruption at all? What if, in a market this volatile, boring is actually beautiful?
And that's exactly what brings us to Jack Henry. Now, this is not some hyped-up startup. This is a quiet powerhouse, the hidden engine that has been powering American banking for decades. So let's explore what they do, why their business is so incredibly resilient, and what the numbers tell us about where they're headed.
So, first things first, what does Jack Henry actually do? Let's get right to the heart of their operation.
They provide something called core processing. Honestly, the best way to think of this is as the central nervous system, or the operating system for a bank. It is absolutely mission critical. Every single customer account, every deposit, every loan, it all runs through this system.
And here's the clever part. They don't serve the giant Wall Street banks. Nope. Jack Henry has brilliantly carved out its own niche, community banks and credit unions all across America. For these smaller guys, Jack Henry isn't just selling software, they're basically their entire tech department, a true one-stop shop.
Now, the sharp focus on a niche market has allowed them to build one of the most powerful things in business, an incredibly wide economic moat. And it's all built on what we call unbreakable customer lock-in.
And if you need proof, just look at this number. Their annual core customer retention rate is a staggering 98%. Let that sink in for a second. Once a bank signs on with Jack Henry, they almost never, ever leave. This isn't just good customer service, it's baked into the business model. So why is that? Well, it all boils down to ridiculously high switching costs. For a bank, swapping out its core operating system is like performing open-heart surgery on the entire business. It is a nightmare. You're talking about complex data migration, retraining your entire staff, and most importantly, it's just plain risky. If anything goes wrong, the whole bank could grind to a halt.
As one deep dive put it, these high switching costs just create a powerful status quo. It's just so much easier, safer, and cheaper for a bank to stick with what works, and that, my friends, creates an incredibly stable and predictable gusher of revenue for Jack Henry.
Okay, so great business, wide moat, we get it. But does that automatically make it a great investment? To answer that, we have to look at the numbers, both the financials and what the stock is trading for right now.
First off, Jack Henry isn't a get-rich-quick, hyper-growth story. It's a story of incredible consistency. Their revenue has been growing at a compound rate of about 6% a year. Now, that's not going to blow the doors off, but it's remarkably steady. This is the definition of a slow and steady wins the race kind of company.
And here's the secret sauce behind that stability. A whopping 80% of their revenue is recurring. We're talking long-term contracts, maintenance fees, things that come in like clockwork every single quarter. Investors absolutely love this kind of predictability, especially when the market gets shaky.
So what about the price tag? The stock is trading at around 25 times what it's expected to earn next year. Now, that's actually below its own historical average, so it's cheaper than it has been. But yes, it's still at a premium compared to a peer like Fiserv. The market is basically saying, we know this is a higher quality, more stable business, and we're willing to pay up for it, but maybe not as much as they used to.
And when I say quality, I mean it. This company has a fortress of a balance sheet. They operate with basically zero net debt, they gush free cash flow, and get this, they have raised their dividend for over 32 years in a row. That is just incredible financial discipline, something you rarely see in the tech world.
But look, no investment is without risk. A company that's built on older, reliable tech has to prove it can keep up. So, how is Jack Henry handling the future? And what are the potential storm clouds on the horizon? Well, they are absolutely not standing still. They are actively modernizing. Their acquisition of Bono for digital banking has been a home run. They're in the middle of developing a totally new cloud-based core system, and they moved fast to get hundreds of their clients up and running on the new FedNow instant payments network. This so-called boring company is definitely evolving. Of course, there are outside risks to keep an eye on. If community banks get into financial trouble, they might cut back on their tech spending. And the other big one is the long-term trend of bank mergers. When banks combine, you can sometimes lose a customer. These are the two key things you really have to watch. Okay, so let's put it all together. What does this all mean?
Let's boil this down to the core investment thesis.
Here it is in a nutshell. First, you've got a business protected by a massive, durable moat. Second, you have an incredible management team that thinks in decades, not quarters. And third, you can get this high-quality defensive company at what looks like a fair price. In fact, Morningstar thinks it's about 20% undervalued today.
And that takes us right back to where we started. In a world of hype and chaos, maybe the smartest move is to find quality and predictability. For any investor looking for a resilient, steady compounding machine, Jack Henry makes a really powerful case that, yes, predictable might just be the new profitable.